order. And I'm going to ask the clerk of the board, Beth Stickler, to call the roll for the meeting.
Will do. Trustee Martin,
Here.
Trustee Worth,
Here.
Trustee Riley,
Here.
Trustee McMahon. There you go.
Thank you. Thank you. And just a reminder, keep all your, please keep your mics muted when you're not speaking. And we're going to introduce the first item and turn the meeting over to Jenny to go over tab 1, the FY 2027 increase to the endowment management fee. Actually, I'll back up. We're going to turn the meeting over to President Joan Farini Mundy and Jenny to go over tab number 1. Welcome.
Good afternoon, everybody. Thank you very much. And I'm only going to get this started and then speak to turn it to Jenny, who may also need to look to Tracy and Ryan. But as you all know, part of the endowment that is available to the University of Maine is held at the University of Maine system for interesting historic reasons. That's a perhaps different discussion for a different day. But what we're bringing to you today is a request to increase the management fee portion of the UMaine endowment that sits with the University of Maine system to increase the spending rate from 1.25% to 1.75%, effective for fiscal year 27. This would, it still sits within the range of what the board allows, as I understand it, but also it would benefit the university greatly to be able to see this payover increase as we look to maximize every possible source of revenue that might be available to us in challenging budget times. I can tell you also, and Jenny can speak more to this, that the UMaine Foundation also looked at a similar action, and they've made such a policy change, but it will be a little bit different. That will be a payover change on the portion of the endowment that is directed toward particular causes. And so we'll see a large revenue result there on scholarship-based funding largely that will also help alleviate our student financial aid challenges. So the combination of these two will be very, very helpful to the university. Jenny perhaps should jump in and correct anything that I've said inaccurately and also add more detail as needed.
Thank you. I don't think you've said anything inaccurate. I would agree that we're requesting a 0.5% increase in the management fee portion that comes over. It's about a $468,000 impact to the University of Maine budget and will help offset some of our structural gap for the next year. We don't anticipate that it would cause issues on campus, as other than the scholarship lines, this would be a very small change in the payover amount that is spendable by the different departments who, other than the scholarship lines, don't always fully expend these payovers.
Do you have any questions? Anybody want to add to the conversation on item number 1?
Trish has a hand up.
I'm confused. I thought, so this is an administrative fee on the gifts, on the total endowment?
Yes.
Okay, and you're increasing that by 0.5. That's different than a gift. At one point there was some discussion about a gift tax or something. That's different than that. This is just an administrative behind the scenes increase.
I'm not familiar with what the discussion was about a gift tax, but this is just increasing a current fee that that is assessed now.
But the foundation will not they're doing something different.
They are taking a different path and increasing the spending payover, which will provide a benefit to us.
And we're not doing the same thing. We're not being consistent with that because
we had provided this option to them as well. We'd talked to them about if they wanted to pursue this option. The option that they chose actually has a higher benefit to us than what we had proposed to them. This is what they came back with, was an increase to the endowment spending.
And the difference is that that's slightly more restricted for us, as I understand it, because it would go against our scholarships and student financial aid, where this is a bit more flexible in where it would be deployed. The other thing I would add, and again, I'd have to look to Jenny and possibly Ryan and Tracy to know, but the endowment that sits with the foundation, I think the Humane Foundation has been working to be sure that gifts come in recent times properly allocated so that they are going over to the Humane Foundation and not being held necessarily in the system portion. Now, I don't know, there may be some historical reasons why there are certain gifts that keep coming in there, but I don't know how rapidly that is growing compared from new gifts compared to what the foundation is doing. Tracy, does that point make any kind of sense? Are we still seeing much coming in to the
Not
system?
as much as we used to. Yeah, that
So
it has
this-
significantly
It's
decreased.
small.
And I would
Over-
just, sorry.
I'm sorry, Tracy, go ahead.
I was just going to add to this discussion about the fee. So this fee is on endowments and not outright gifts. So the total,
Okay, against the, yeah, okay.
what we've
But-
charged in the past of the 4.5% endowed spending, of that amount, some campuses in the system charge a fee. So this is a subset of the distribution for endowments only, system endowments held in the managed investment pool only.
And that's fairly small amount of money compared to the foundation, right?
You're saying the Humane endowment? I wouldn't say it's small.
It's sizable.
But the
Okay.
right, this fee spending will be small, but the endowed amount is relatively large.
So
Yeah.
there won't be any, I'm just worried about people who contribute, donors. There won't be any difference for donors are treated. I mean, we've got two systems now that work differently. The foundation and the UMS endowment on the fee issue.
We would work with the foundation to be sure that we're clarifying to any donor coming in how those payovers are working. But again, because the majority of our donations are currently coming into the foundation and being charged in the way that they will describe, I think there would be some perhaps that would see this and be told, yes, it's going toward a portion which is essentially an administrative fee. But that would be notification that our foundation is more expert in doing that than I would be. So I'm assuming we'll work with them. Again, Tracy may have more to add to this, how this works.
Well, and I would say for this fee, this system manages, the accounting department will make those distributions and they go through our general ledger, and those are monies that are already given, and the endowment distributions to the campuses toward the scholarships or whatever other endowed spending. So this piece is something we manage internally, and the foundation controls their own spending rate for the gifts given. If a check comes into them for Humane, that gets deposited into the managed investment pool. If it's for Humane, if it's gifted to the University of Maine Foundation, so they
Foundation, right,
manage
right,
the
yeah.
monies coming in, but whereas the University of Maine Development Office used to manage the receipt of funds and the deposits and such. So it's just, the foundation is a different entity. And the monies that we're talking about here are the ones in the managed investment pool that we will be distributing to the campuses for the FY27 budget. Does that make sense?
It's probably me, not you.
And maybe there's a piece I don't understand. President Fabrini Mundi, I see the question in your eyes.
And obviously, I probably don't either, but I suspect that Chair Riley may be asking if there's a need to notify donors that some portion of the payover is going to a fee versus going to the cause that they are donating for. But I may have that wrong,
Yeah.
Chair.
I wonder if we haven't already addressed that one though. When we implemented this policy originally and the board put this in place, or this committee put this in place, correct me if I go wrong here, Tracy, but we had a lot of that conversation, as you would expect the first time you implement a fee like this. And so the fee itself has been around for a long time.
Right,
We're
right.
talking about is just changing the rate
Yeah.
a little bit. So nothing is changing, you know,
Okay.
if you do this or if you don't with donors. I mean,
Yeah, I guess where my confusion was that the foundation was doing something different and it's fine.
Trustee McMahon?
Somebody has a charitable remainder trust invested in these funds. What we're doing here is potentially reducing what they would get as an income payout from the charitable remainder trust. So my question is, are there any charitable remainder trusts in there? And are we notifying people that the payout will be reduced?
Trustee McMahon, I don't have the expertise to answer that question. I can check on that for sure. But Ryan or Tracy may.
Well, I would add that the university does have very few of those. Darla manages those, and I don't believe that until the individual passes, I don't believe any of that money is available for our use. And also, it would only be applicable if it was an endowment. So I can check with Darla on our side, but I don't know that that's relevant for this piece of it. I don't think it's part of the endowment.
My question is, if it is a charitable remainder trust, then the beneficiary of the trust initially is the donor. And the donor will be getting a percentage payment out of the trust. So if we're increasing the administrative fee, then the funds available for donor payment are diminished.
I can confirm, but my understanding is we don't take any fees out until we actually own that money. I know we have payments that go out. I don't believe there are any fees charged on it during that person's lifetime. And I don't know that it would be an endowment even after. It would depend on how the terms of that agreement are stated. But I will follow up. I don't want to guess, but I don't think it's part of this. But I can double check with Darla.
I was concerned at all.
No, I understand, but I'll follow up.
Thank you. Any other questions, concerns? Anybody want to add to this? Looks like hearing none. I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves an increase to the management fee portion of the UMaine endowment spending rate from 1.25% to 1.1 3/4, or 1.25% to 1.75%, effective for FY 27. Any questions or discussions? Can I have a motion?
So moved.
So moved by Trustee Worth. Second? Get a little bit. Do we want to have more discussion on it?
Well, if I understand that it's taking a fee that everybody understands, that's already been worked through on the charitable trust liability issue, and it's simply increasing it, then second.
And I just want to add, I would assume when you're sitting down at the table with donors that's probably fully disclosed, right? Yes, no?
Again, I assume so.
Yeah.
Martin. We'll confirm with the foundation who would handle this limited number of donations that come through this route at this time.
Okay. So with that being said, I'll turn it over to our clerk of the board, Beth, to take a roll.
Trustee Martin,
Yes?
trustee Riley,
Yes,
trustee Worth,
Yep.
trustee McMahon,
Yes.
the motion carries.
Thank you. And moving on to tab 2, the FY 2027 endowment spending rate. And I'll pass this over to Tracy to review the spending rate. And I can't even believe we're talking 2027 right now. That's the years are going by.
Thank you, Chair Martin, and good afternoon, everyone. This agenda item in tab 2 is to review the recommended fiscal 27 endowment spending rate. We've reviewed the information and the detail with the chief business officers, and with their support, recommend the 4.5% rate for the coming fiscal year. It's consistent with prior years and is well supported by the managed investment pool's long-term return expectation, and also provides confidence that we will preserve endowed spending for future generations in perpetuity. This rate would provide an estimated annual distribution of $6.85 million in fiscal 27, and that includes both endowed spending and the internal management fees that we just discussed. And with UMaine's approved fee increase, the total endowed spending would be an estimated $4.98 million, with internal management fees of $1,860,000. Our confidence in the 4.5% rate is grounded in NEPC's analysis of the managed investment pool's expected returns, and their letter was included in your materials. Their 30-year capital market assumptions indicate an expected return range for the MIP of approximately 7% to 8.1% before any manager outperformance or fees. Adding that, their range increases by another 50 basis points. The 4.5% recommendation maintains a meaningful spread between expected returns and endowed distributions, allows for volatility in our annual returns, helps preserve purchasing power, and supports endowment growth over time. If this is approved, it will be utilized to finalize the fiscal 27 distribution rates per share, and will provide those budgets to the campuses for their planned use. And I'm happy to take any questions before we ask for your vote.
Any questions for Tracy? Hearing none, read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves an endowment spending rate of 4.5% for FY 27. Any additional questions or concerns? Discussion? Hearing none, can I have a motion?
So moved.
So moved,
Second.
is that Trustee McMahon and seconded by Trustee Worth? And I'll turn it over to you, Beth, for the roll call.
Trustee Martin,
Yes?
trustee Riley, trustee Worth,
Yes.
trustee McMahon.
Yes.
The motion carries.
Thank you.
Thank you.
And we have I see Kelly's on the phone and Matt from NEPC. So I'll turn it over to NEPC to review the capital markets and quarterly performance. They'll also be discussing in tab 4 the fossil fuel exposure update.
Great. Well, thank you, and nice to see everyone again. Yeah, we'll be talking over capital markets first, then we'll jump into some performance, and then Kelly will give us an update on the fossil fuel exposure. So maybe jumping right into performance, yeah, we'll go to page 3 here. As you can see, it was another strong quarter for equity markets. The US large cap, as represented by that S&P 500 number, up over 8%. US small cap, as represented by the Russell 2000, up over 12%, which isn't something we've seen for a while. I mean, large cap has really dominated small cap more recently. And sort of the rotation here, largely due to the rate cut that we saw come through in Q3. However, as we'll talk about when we get to the manager performance, this is what we would describe as sort of a junk rally, and that some of the lower quality names are really driving the return differential this quarter. And then in the non-US markets, right there at the bottom of the MSCI emerging markets, up over 10%. This is driven by, China was up over 20% for the quarter. There's also some Taiwanese AI stocks driving performance. So really good stuff coming out of emerging markets. But then right above that, the MSCI EFA represents non-US developed, up only about 5%. So still, good performance on an absolute basis, but trailing some of the other equity markets, just given the limited tech and AI exposure within those markets. And then in the middle of the page, fixed income, up across the board, largely driven by lower yields, tighter spreads, which are actually historically tight now. And then also, the Fed cut rates by 25 basis points, as I mentioned. So starting to see that priced in, especially as they start shifting from reining in inflation to maybe bolstering some of the labor market. And then just to round out the real assets down at the bottom, commodities rebounded in Q3 despite the oil falling about 6%. And I think no surprise here, but gold really led the way. I think it was up over 17% for the quarter. So that could be just a reflection of market participants' sentiment around tariffs, inflation, geopolitics. So just some interesting dynamics there. This is as of the end of Q3, just to sort of bring you up to speed of what we've seen in Q4 so far. Markets are up, not quite as much as what we've seen in Q2 and Q3. And there's been a little bit more market breadth. So some reversal of some of the trends we've been seeing in Q2 and Q3. Things like, AI stocks have started to stumble a little bit. Value has outperformed growth so far in Q4. And then within EM, China's actually down for the quarter so far. That's sort of layered on top of the government shutdown that we got in October and into November. So there's sort of this lack of data as we go into a Fed meeting next week. The markets are pricing in, I think as of a couple of days ago, it was roughly 80% that there would be a rate cut next week, but they're flying blind a little bit. So could be the case that they sort of continue course, but maybe at a slower clip. So be interesting to see. And of course, more recently, Trump announced he had chosen a successor to Chairman Powell, but hasn't named who. So when and if that does come, the markets are likely to sort of hone in on what that person says versus more of what Powell says. We do have some interesting slides I do want to quickly touch on. Kelly, if we go to page 6, maybe, really quickly, just to highlight, to visualize that large cap, small cap dynamics. What you're seeing here is the Russell 2000, which is the small cap index versus the Russell 1 cap. So anything above that 0% line means small cap outperformed. Anything below means that small cap underperformed large cap. And we can see here, large cap has really been dominating markets since COVID times. And when we do see those spikes when small cap outperforms, it tends to coincide with the rate cutting cycles, which we saw more recently and as well as back in the end of 2024. So to the extent that we do get more rate cuts coming into 2026, would be an interesting dynamic to keep an eye on. And maybe jump forward to page 10. We can quickly look at the labor market and sort of this lack of data that the Fed is currently working with. We can see we started to see some of that labor market weakness creep in July, but with the June numbers, you can see that dark blue line in June 2025 came in pretty strong, healthy, but then that first revision really brought it back down towards a 0, and then that final revision actually a negative number there. And then in July, somewhat healthy, not maybe as quite as good as we've got in prior quarters or prior months. But then we didn't get a final revision, and then we just got that first initial release in August. So the Fed saw the labor market weaken, but hasn't really gotten any more data since that point. So how markets are sort of pricing this in, if we go to page 12, we can look at see how they're pricing this in terms of how it might flow through to rate cuts. So this just shows what the market's pricing in on the end of 2024, the end of Q1, the end of Q2, and the end of Q3. You can see in start of Q3, that 630 number, we started to see the curve start to steepen. So markets, we saw the labor market starting to weaken. Markets are starting to price in more rate cuts. And then Q3 sort of following that same dynamic. And what this amounts to is roughly 3 to 4 more rate cuts, so 75 to 100 basis points, and more rate cuts by the end of 2026 is where we land towards the end. That's what the market's pricing in. As we'll see on page 15, which is our sort of our market outlook, to the extent we don't get that number of rate cuts, or maybe the Fed sort of goes a little bit more slowly than what the market's pricing in, that could be a headwind to markets. And a lot of that would likely be due to the lack of data that came out during the government shutdown. So those top 2 points there are sort of in tandem of what we might expect going into 2026. In the middle there, equity markets, as I mentioned at the top, have continued to run. So to the extent they're overweight, we would recommend considering rebalancing back to target, just given, some of the potential volatility that we have seen, that we kind of expect to see going forward, really encouraging clients to sort of hug those targets fairly closely. Sort of in line with that second to last bullet point just being one that to ensure sufficient liquidity is available for any cash needs or rebalancing to the extent we see some sort of market dislocation, are encouraging clients to do so. And then finally, maybe less pertinent, but I'll touch on it really quickly, that bottom point, just using high yield as a funding source, that, as I mentioned at the top, the spreads have really come in. So you're not really getting paid as much as you would have in the past to taking that high yield risk versus investment grade risk within your fixed income bucket. So to the extent there are cash needs, we're encouraging clients to maybe use that as a funding source going forward. I went through that really quickly, but were there any questions on markets before we jump into the portfolios specifically? Okay. Well, not hearing any, maybe let's jump forward to page, I think it's, 17, great. With the operating fund, currently sitting about 280 million, which is about a $31 million increase from last quarter, both due to some inflows and some positive performance. This is the most conservative of the three portfolios, roughly a third in cash or cash equivalents, although we remain in line with targets and ranges here. If you look at the performance in the upper right-hand corner, performed in line with benchmarks. I think as we've discussed in the past, the alpha potential for this type of portfolio is going to be pretty limited, just given the allocation to cash and fixed income. So, pleased with the performance here, but we wouldn't expect to see, strong outperformance like we would hope for the other two portfolios. There was one manager announcement. BlackRock had a senior portfolio manager and the likely successor to Rick Rieder leave BlackRock, and it was effective immediately. So he was one of three portfolio managers on the Strategic Income Opportunities strategy, which is in all three portfolios. Rick Rieder, who leads BlackRock, remains the lead private markets or the lead portfolio manager there. There's no indication that Rick is planning to retire. He is nearing retirement age. He was at one point sort of in the mix for next Fed chair. It seems less likely now, but just sort of with that senior PM's departure, just makes that succession planning a little bit more unclear. So we've put BlackRock on watch, but nothing really to do at this time. And then we don't have any specific recommendations for this portfolio or really all three portfolios at this time. So maybe shifting gears to the pension fund on the next page, currently at about 16 million, which is a slight increase, had some positive performance, but there was some outflows there. This is going to be more aggressive than the operating fund, a larger chunk to global equity, which I think is sitting about 31.5% right now. And like the operating fund, we are in line with targets and ranges. The upper right hand, the performance there, it's going to deviate more than we would expect from the prior pool, just depending on how managers are doing. And unfortunately, there is some underperformance there coming almost entirely from the three global equity managers of Walter Scott, Impax, and Linslow Train. And we'll talk a little bit more about what drove those returns going now and what we would expect going forward here in a minute. There were two major announcements. One, the BlackRock that we just discussed, and there was another one with Vanguard, which was no action there. The SEC had fined Vanguard for not adequately disclosing some conflicts of interest related to their incentive compensation, not really associated with anything related to the portfolio's investment. So no concern there. However, the firm does remain on watch just following the appointment of a new CEO back in May of 2024. And then finally with the MIP here, currently at about 405 million, a slight increase, in the 9+ million range. There were a little bit of outflows, but some strong absolute performance, increasing about 13 million there. In line with targets and ranges, like we talked about with the pension fund, it did lag, largely due to the three global equity managers. But also there was one U.S. SMID-cap manager in Westfield that we'll talk about here, sort of didn't benefit from that junk rally that we had talked about at the start. The rankings here, generally lagging over the long run, which we would expect just given no private markets, which we do still believe there's an illiquidity premium there. However, kind of an interesting dynamic this quarter, just given that when public markets perform well, we'd expect it to rank a little bit better. We obviously aren't seeing that come through in these numbers, and that's almost entirely due to those active managers that we'll talk about and we have mentioned so far. And then just the same two manager announcements as the pension fund, with BlackRock and Vanguard being the two manager announcements there, with no recommendations for this portfolio at this time. Any questions before we go into the manager specific performance? Okay, great. So maybe if we hop forward to page, I think it's 22 here, or 21. Just to take these in order, there's a lot of overlap between the pools, so we'll focus on the MIP here. SSGA, a passive fund, relatively new strategy here, in line with its benchmark, which you would expect. It's going to out or underperform just depending on how energy is doing. So no concerns there. But kind of getting into the active performance that didn't do so well in Q4, Westfield, Walter Scott, Impax, and Lintel Train. Westfield at the start there, you can see, had positive performance, up 3.6%, but trailing its benchmark pretty significantly, which is up 10.7%. So this is a manager, sort of a fundamental, bottoms up, growth at a reasonable price type manager. It does have a quality bias, which is what really hurt them in Q3. They're not going to own any of the speculative or overpriced growth stocks, which are really what ran in Q3. Just to put some sort of statistics to that, low quality names within the Russell 2000, so the small cap universe there, were up 20%. The high quality names, which is more where Westfield plays, were only up 7%. So they did underperform those names, but not quite to the degree that you would expect when you look at these numbers just in isolation. Some of the non-earners, or the names or the stocks in the Russell 2000 that have no earnings, make up 20% of the Russell 2000. Those returned 26% for the quarter and contributed 36% of the overall Russell 2000 index return. So they are really driving the name or the performance within this. And unfortunately, just somewhere in Westfield, and a lot of active managers aren't really going to play. So active managers in general, it's not just Westfield, kind of struggle in that type of environment. And then finally, just to hit it home, there were 60 names within the Russell 2000 that actually doubled in price in Q3. 51 of those were unprofitable. So just to show you that, it's really these unprofitable junk rally type names that really drove performance. So we still like Westfield as a manager, no concerns with it as a strategy. We hope that sort of this dynamic were to sort of reverse as we go forward, and we think it will in the long term. All right, shifting gears to global equity. The three managers here underperformed. The one that we're sort of most concerned about, if you will, would be Walter Scott right there at the top. You can see up about 1.8%, so positive, but underperforming its benchmark, and more recently has underperformed, more so than the other managers as well. This is going to be a conservative growth manager, tends to have about 40 to 60 names, have very low turnover, but quite frankly, the performance we've seen has been outside of our expected range of outcomes, just given the markets that we've seen. It's not going to hold much of the Mag 7, and we would hope that as market breadth expands, like it did in Q1, a little bit so far in Q4, that it would perform a little bit better. But this is one that we're re-underwriting as a firm, and we may, as we go forward, recommend some changes associated with Walter Scott. Just more specifically, some of the negatives that brought them down in Q3. They had an overweight to healthcare, so some names like Novo Nordisk, which had struggled more recently, Intuitive Surgical as well. They also had an underweight to technology. Like I mentioned, they don't hold much in Mag 7, but in particular, they didn't hold Apple or NVIDIA, which really performed well in Q3. So more to come on Walter Scott. That's something as a firm that we're looking at and may have some recommendations in the future. Impax is one that still underperformed, but did perform better than the other two global equity managers here, up 4.6%, is still slightly trailing its benchmark here. It slightly underperformed Q1. It bounced back in Q2 and actually outperformed, but underperformed again this quarter. It's still ranking okay. You can see that year-to-date number, keeping up pace, and it's 66th percentile. It's been some of their key holdings, things like materials, industrials, and some of their thematic investments. So think things like water or energy resources, or more of their durable holdings like waste management, recycling. Those just didn't really hold up well in more of a growth-focused, AI-focused type market. So no concerns with impacts, and this is one we'd hope to see turn around as sort of the market turns over from an AI-dominated theme to maybe a little bit more market breadth. Lindsell Train, obviously the most disappointing from an absolute basis, down 4.6%, and really underperforming its benchmark. This is one that we don't have any concerns with the manager, but it is sort of a striking number to see there. It is sort of within the realms of what the performance expectations would be here, so we're okay with it. However, this is a manager that we'd like to see turn around as value maybe becomes more in favor. Tends to be really highly concentrated. They're not going to be benchmark focused here. They have a very long multi-decade buy and hold type strategy. That value tilt really hurt here. I think within their benchmark, which is the MSCI World, the top 9 performers in that benchmark were all US tech companies that invest in AI, and that's just not really somewhere that Lindsell Train is going to play super heavily. So those 9 names accounted for over half of the MSCI World's Q3 return. So sort of more of that same dynamic that we talked about. It's really that narrow market leadership driving returns, and not somewhere where Lindsell Train is going to play. But given their long-term time horizon and their value tilt, we think they are well positioned moving forward. Moving down into maybe the international markets, Silchester, strong absolute performance, slightly behind its benchmark despite its value tilt there. Q3 up, year to date up, and international developed was really the place to be year to date. You can see Silchester is up 21%, and slightly underperforming its benchmark, but up over 20% so far in 2025. And then Acadian, this is a new manager here, performing in line with expectations, up over 10%. This is going to be your quant manager. No real concerns here, and look forward to seeing more performance as we get some coming into 2026. Maybe shift gears to the fixed income portfolio on the following page. This portfolio has been a strength. It's outperforming or in line with its benchmark in all time periods, ranking really well. You see that 10-year number at about 28 in the 28th percentile. Getting good returns basically on all the managers here. Fidelity did well. Common Fund is one that has been liquidated and being replaced in IRNM, as we discussed at the last meeting. I think that was effective in December 1st. And then BlackRock, SIO, and Bain providing strong performance, particularly when you look out sort of that 3 and 5 year number. So really no concerns within fixed income, especially now that we've swapped Common Fund out for the IRM strategy moving forward. And then Newton in the total GAA outperformed in Q3. So it was in line with Q1. I think it lagged a little bit in Q2, but outperformed again this quarter, and now in line year to date. So that was good to see. This is one that is going to have some periods of underperformance, some periods of outperformance, and you can see that sort of evens out to a long-term number in line with its benchmark. Q3 in particular, they had some positives coming out of their what they call the stabilizing layer, and some exposure to some precious metals like gold. And then in a rising market, as you might expect, sort of their negatives would be more of their hedge positions, their currency hedges, their derivative hedges, sort of detracted a little bit from their performance. And then Lighthouse, similar to Newton, sort of long short manager. They are ranking a little bit below median, but positive performance here and performing within expectations. In Q3 in particular, they got some good performance out of their long book. They had some beta exposure, did well. They were long momentum, technology, industrials that performed well for them. But on the negative side, they're hurt by some of their sector hedges, as with Newton, as well as some of their short book, and particularly within IT services. And then Landmark, I just always want to hit on this, that this isn't really the right metric this time, weighted return to mention Landmark, but we do have a later page in which we measure them against their dollar weighted or their IRR. And that IRR since inception was about 10.2% as of the end of Q2, which is going to be in line with managers of a similar strategy. Maybe rounding it out with the other managers we haven't touched on in the pension fund. I think Baird was one which is being liquidated and replaced with IRNM. But then on the following page, Principal had another good quarter there, up 1.1%, and this follows a strong quarter in Q2. That's helping to bring them, back into their long-term performance targets relative to their benchmark. Just some of the dynamics we've seen in the real estate market, has been beneficial in the past 2 quarters. And then finally, in the operating fund, I think there's a PIMCO name in here, PIMCO All Asset towards the bottom, outperformed in Q3 and is outperforming in all trailing time periods. So it's done really well relative to its benchmark. And this is going to be one that's very different than peers. Most are going to have that 60-40 between equity, sort of fixed income like investments. PIMCO is going to have a little bit less equity exposure. So that's likely while their rankings are going to be below medium. But hopefully going to provide you the absolute return and strong diversification, particularly as it relates to inflation. Q3 didn't really have many detractors, but some of the positives they had within their portfolio within REITs, they had some MLPs, and they had some exposure to emerging markets equities, which, as we talked about at the start, were up over 10% for the quarter. So I think that wraps up the manager's specific comments. Any questions before I turn it over to Kelly to talk about the fossil fuel exposure? Yeah, Matt Scaves, do you have a question?
Yes, thank you. I was just wondering, at what point, if any, does it make sense, particularly in the global equity space, to consider adding a passive allocation? I mean, I understand that that we're pretty much all active with the hope that we can get outperformance. The challenge is that there's never any guarantee of outperformance, and then you add, at a minimum, some tracking issues, and at worst, you get, periods like this where there's just underperformance across multiple holdings. And adding a passive core at least helps to cushion that blow during those periods when all of the managers are kind of out of favor with their strategies in a market that is very narrow, but also kind of that narrow, set of stocks is rallying very strongly. So I'm just wondering what your thoughts are on that.
Yeah, that's a great question. I think just at a firm level, we would prefer to take the passive exposure within sort of your more like US equity, non-US developed and EM buckets specifically. And then maybe there's a case to be made for reducing the global equity, allocation as a whole. But generally, if we're going to go passive, it's probably going to be within those more granular buckets. So then we can account for that allocation, whether it's to US, non-US, and EM, to sort of strip out your manager out or underperformance from sort of the allocation decision and where your targets are relative to the US, non-US, and EM. Within global equity specifically, this is an area, I know it doesn't look like it from these numbers that we're seeing here, but is an area that we feel can be ripe for active management, particularly in different environments, just given the latitude that these managers have with their mandates. We don't often see a passive investment in global equity. Just like I said, we'd likely to split that up into 3 smaller chunks between US, non-US, and EM, and which is what we see with that. There's in the MIT portfolio, the SSGA, sort of a core domestic passive strategy there. So we'd likely, if we were to move that route, probably add to that, maybe potentially add a passive to the non-US and to the EM as well. So it's just an area that we feel like if you are going to go passive, you're probably better off doing it at the more granular level. And if you are going to take the global equity, being more active, because what you're getting from global equity is more of that latitude where hopefully good managers can outperform over the long run. Does that answer your question, or do you have any other follow-up questions?
Yeah, thank you. Just a quick follow-up question. So then relative to, your kind of average client, what is our percentage of global equity versus kind of your typical portfolio?
Yeah, Kelly, what have you seen here in terms of the percentage there? I would say we probably don't see, you're never going to see something like probably 50% plus type there in global equity. But I don't know, Kelly, any thoughts on what you're seeing across your clients?
Yeah, I would say generally 10% is like a pretty average allocation to global equity. I would say one of the things that is a little different for the University of Maine system is one of the reasons why we have global equity is not for the reasons that Matt just, or for the reasons that Matt just mentioned, like the active management component areas that we think can add alpha, but it's also the areas where there is no fossil fuels with these managers. So if we were to think about passive management, we would need to be considering passive management that have no fossil fuels. And so there are some limited options out there, but it's not as fruitful as it is like just the S&P 500 that you see in the MIP. So I would say generally 10%. I would say the other thing that's different is for the pension fund, just because of the size of the pension fund. It's, it was our belief that it'd be easier just to have less managers and just kind of bucket all equity into global equity and not have the breakouts with large cap, small cap, international, and EM.
Both.
Great. Any other questions before we shift gears to the fossil fuel exposure review?
Yep, I'll
Trustee
chime in
Worth?
real,
Yes.
chime in real quick. Can you talk, whether it's generally or specifically, I think we've all seen headlines of artificial intelligence risks, first half GDP is close to zero without AI data center spending, circular financing risks with, NVIDIA, Oracle, OpenAI, Microsoft, et cetera. 37% of the S&P 500 is the Mag 7. Can you just talk, whether it's generally or specifically, about our exposure to a downturn in artificial intelligence spending, whether that comes as a result of a broader economic recession and pullback, or realizations from some of the top companies that maybe their spend is too high and they're getting compressed margins, or whatever the reason is? What would that look like for our portfolio, either as a strength because we don't have as much exposure as our peers, or as a potential risk due to our S&P 500 and other capital exposures?
Yeah. Yeah, you correctly pointed out, AI is really driving markets here. There's no getting around if the AI theme were to sort of reverse and we did see a downturn, the portfolio would likely also see a downturn, but it's positioned in a way that from a relative basis, from the policy targets and their individual targets, we would hope that we would see some outperformance there. So position this at probably more of a defensive nature with that value tilt for a lot of these managers, Lindsay Train being one. We would still see, get broad market exposure with the SSGA fossil fuel here. So we would see however the market goes, that would go. But some of these other active managers have more of that quality value tilt, which would hopefully protect more on the downside. But on the flip side, when we see markets continue to run, likely see some underperformance there. And, this isn't unique to this portfolio and that the active managers are underperforming. That's something that we're seeing across the active manager landscape. It's really difficult when you are an active manager and you have 30+% of the index in 7 names, because in order to differentiate yourself, you really have to be different than the benchmark. And when you're different from the benchmark and those names are really driving performance, you're going to underperform. So it's been difficult for active management in the start, but to the extent that shifts, we would expect that to be where active management is really going to provide its value and provide a little bit more downside protection that you would get from just a beta exposure to the overall market.
Thank you.
Any other questions?
Looks like that's everything. Thanks for the amazing presentation, Matt.
No problem. Well, Kelly, do you want to take us through the fossil fuel exposure?
Absolutely. Thank you,
Hi,
Matt.
Kelly, welcome.
Good afternoon, everyone. Good to be with you. So just have a few slides here to update you on the fossil fuel exposure. So first, just as a reminder, the University of Maine system has adopted a number of what we call impact investing approaches. The more recent one being the fossil fuel divestment that was approved in 2022, with the goal to be fully divested in fossil fuels by, I believe, 2030. And so over the last 3 years, NEPC has been working with you to reduce the exposure to fossil fuels across the portfolio, mostly through making investment manager changes. So the things like the SSGAX fossil fuel index, the Silchester X fossil fuel, Acadian, your emerging market manager X fossil fuel. So finding appropriate managers that we think are high quality in nature that can outperform benchmarks, regardless of having the fossil fuel exposure or not. So every September we look at kind of where the current fossil fuel exposure is. So we've done that as of September 30th. And happy to report that the exposure of all 3 portfolios continues to come down. And we'll go through a few slides on that, but it's come down quite significantly. Part of that is due to some investment manager changes. Another part of that is due to, if you remember, the goal is to look at the exposure to the Carbon Underground 200 list. So it's a list of 200 securities developed by an index provider that they've determined are the most fossil fuel oriented companies. Up until recently, we were asking investment managers to say, hey, can you give us your exposure to those 200 securities? A good number of the managers had that list. You have to pay for that list. But a number of managers didn't have access to that list, and they would just give us their view, their definition of fossil fuels, and give us an exposure. We were able to get the list. So the University of Maine system through Tracy's office has the list. We've provided the manager holdings to Tracy to run against that list because there are some confidentiality requirements with that. And so you'll see a few managers here where in previous years they had fossil fuel exposure, but when we actually look at their holdings versus the Carbon Underground 200 list, they do not have exposure to that list. So that is another reason why exposure has come down, because we've been able to get a little bit more granular on looking at things. Just to put this into perspective here, when we started looking at fossil fuel exposure at the total level, so all 3 portfolios, we're looking at about 2.5% of total assets exposed to fossil fuels, or that was about $14 million. When we look at that today, we have about a 10 basis point exposure to fossil fuels, or about $600,000. So it has declined significantly. And even compared to last year, which is the light blue bar, you can see we had about 60 basis points of exposure to fossil fuels, again, coming down to 10 basis points, or about $4 million coming down to about $600,000. So there continues to be significant progress towards the goal of full divestment. When we look at the actual manager, so this is just the managed investment pool here. The left side here is just all the managers listed. Over here in the middle is kind of where the exposures were at the end of 2024 or September of 2024, compared all the way over to the right-hand column here, where the exposures continue to remain at the end of September 2025. So a couple notes is we still have about $100,000 or $120,000 of exposure to Common Fund. But as Matt mentioned, that was just liquidated, and IRNM is being hired to replace. So that will go away because IRNM is a separate account, and it is specifically instructed that they do not invest in any securities in the Carbon Underground 200 list. So within the managed investment pool, the only remaining exposure will be Lighthouse at about $56,000. We move over to the pension. There's a manager, Baird, who has about $71,000 of exposure. And again, as Matt mentioned, they were also liquidated and replaced by IRNM in December. So the only remaining manager in the pension with exposure is Lighthouse. It's $1,700. And then lastly, for the operating fund, Baird, same manager replaced by R&M, had about $350,000 of exposure. So again, the only remaining manager with exposure is Lighthouse at $31,000. I will say that PIMCO All Asset also tends to have exposure from time to time. It's just not listed today. So that is not a fossil fuel free manager. So that could pop up in future years. So overall, really one manager today with exposure totaling about $89,000 of the overall 3 portfolios together. So very small. So what NEPC will do is we'll continue to assess options for removing that fossil fuel exposure. Lighthouse, as a reminder, is a hedge fund, an equity long-short hedge fund. And there are limited offerings of ex-fossil fuel products in the hedge fund space. But we'll continue to monitor the space. We'll continue to make good investment decisions and good investment recommendations to you all. And when the opportunity does arise, we will come to you with a recommendation. So overall, I just want to say that a lot of good progress has been made towards your goal. And I'll just stop there and see if there's any questions. Yes.
Chair Riley?
That is good progress. Thank you. And what I don't remember, Kelly R., do we do a January report to the board? Progress?
My recollection is typically in the month of January, I am sometimes invited to the meeting or provide some information to Trustee Martin and Tracy to present to the board. So more than happy to do so.
Tracy did it last year. But I think we should think about that for the January meeting because it's really good news. So thank you.
Absolutely. Happy to help.
Great, thanks.
Any other questions, concerns? Kelly, thank you so much for the excellent report, and thank you for your guidance and hard work. I appreciate you and Matt.
Thank you. We appreciate
Thank you.
all of you too. And we hope you all have a Merry Christmas and happy holiday season. And I can't believe we're almost on to 2026.
I know. It's flying by.
Same to
Have a
you.
good one. Happy holidays to you as well.
Thank you.
All right. Thanks all.
Thank you,
Bye.
everyone.
Take care. Okay, moving on to, we have Cap Trust on with us right now.
Yep, I'm here, Kelly. It's
Oh,
Mike
you're right.
Crotty.
You're right in front of me. Sorry, Mike. I was looking at David on the boxes. You're right below David's box there. All right. So without further ado, I believe, Mike, are you going to take tab 4?
Yeah, I was going to take. I'm sorry, I don't have tab. You mean just the quarterly review?
Oh, excuse me, tab 5, the defined contribution plan quarterly review. Okay.
Exactly.
So go right ahead, Mike.
Okay, I'll jump into that. And it's great to see everyone. Barry Schmidt is out sick today. So I have a colleague, Brent Hartman, who's from our investment team that's going to join the meeting. I know he had a meeting going right up until 2 o'clock. So he'll join. I'll get started, but he'll join just in case there's any kind of more technical investment questions. Brent will be here to support me. But I'm going to go ahead and share my screen. Let's see. And can you see that okay?
Yes.
Okay, great. Really all good news here today. This should be a pretty straightforward quarterly review. We really have 2 agenda items that I'm going to primarily cover today. The first is the basic quarterly review. I'll start with some market commentary. I'll keep that relatively brief. I know you just sat through probably a lot of market commentary from NEPC, so I'll try to focus on how the markets have impacted your plan specifically. And then we are going to do what we call a QDIA, Qualified Default Investment Alternative Review. After that, it's really just an annual review of the target date funds. We like to do a deep dive into those since they are the default investment choice and a really important part of the plan as well. But certainly, for the most part, really, I shouldn't even say for the most part, really just good news today. The plan looks great. In terms of some very quick updates, as you know, we always like to have a couple industry updates or topical spotlights. A lot of people have probably seen in the press a recent executive order called the Democratization of Alternative Assets in 401k, it should say in 403b plans. And this really is trying to open up retirement plans, defined contribution plans to things like private real estate, private equity, cryptocurrency, different types of alternative investments, which frankly have long been a part of similar plans to what you just sat through, foundations, endowments, pension plans. And so really the executive order is meant to kind of level the playing field, if you will. We do not see this having an impact on the Humane System 403b plan, certainly in the foreseeable future. We need to get some guidance from the Department of Labor, first of all, in terms of what this would look like. But even with that, the thought of having a standalone cryptocurrency investment or, some other type of investment similar to that in your core fund lineup, we don't think makes a lot of sense, certainly in the near term. But we're always, keeping an open mind and we'll keep you posted as this develops. But it has been getting a lot of attention lately, so we wanted to at least mention it, but with the understanding that it's really not going to have any type of immediate impact on the Humane System plan. And then on the right-hand side of the screen, this is really just a reminder, again, not something that the committee needs to spend a lot of time thinking about, but anyone who's doing a catch-up contribution in the 403b plan that makes over $150,000 a year, all those catch-up contributions are going to be directed via the post-tax Roth feature moving forward as of the first payroll in January. So that's something that will likely impact the number of participants in the plan, but not something that I think, this committee really needs to spend too much time worrying about by any means. But just a couple quick updates that I wanted to go through there. Quickly moving on to the markets. Again, as I'm sure you already know, it has been just an incredible year in the markets. If you look at this chart, this is through the end of September. Numbers have actually improved since then. US large cap stocks, that's the Standard & Poor's 500, up a little bit under 15% as of the close of the quarter. That number through yesterday is 17.5%. And today is actually another big up day in the market. The market somehow just shrugged off some poor jobs data that came out today, and we're having another really big day in the market. So S&P 500 up 17.5%. A lot of that, continues to be driven by just a handful of stocks. Those Mag 7 stocks make up, about 40% of the S&P 500 these days. So really not nearly, again, it's just a handful of stocks really impacting that number. Over here in developed international markets, that's the EFI Developed Market Index benchmark, up about 26%. That's improved slightly, about 27% year to date. It's been a really good year for international equities. And then jumping over here to US bonds, the US aggregate bond index up 6%. That number's improved to about 7% year to date. What all this means is that it's obviously been a really good year for investors. It's been a really good year for investors with diversified portfolios. And I would actually say for Humane System, it's been a particularly good year. You folks use as your default investment choice the Vanguard Target Date series. Vanguard has a tactical overweight position to international equities. And so obviously with international equities doing as well as they have done, that overweight position has been really additive from a performance perspective. In addition to that, it's frankly just been a really good year for passive or index-based investors. I guess the flip side of that is that it's been a terrible year, particularly a terrible quarter for active managers, but it's been a really good year for index investors. And so, with the Vanguard Target Date series being obviously index-based and overweight international, it's really just been an outstanding year for people participating in those funds. So really, again, good news from a market perspective. And I would say particularly good news for a big chunk anyway of the Humane System plan. From a forward-looking perspective, it's, frankly, really tough to get any type of forward-looking clarity on the market. There just continues to be so much uncertainty out there. From a tailwind perspective, there's a lot of good things going on. Certainly corporate profits have been good. AI investments have been good. Consumer spending has been strong, especially on the higher end of the market. But there's also a bunch of mixed economic messages and headwinds. Consumer sentiment is down. So, we're really seeing this divide where consumer sentiment and consumer spending is strong, on kind of people who are making more money, and people who are middle income and below, sentiment has definitely taken a turn. The jobs data, we got some, disappointing jobs data earlier today. Again, the market just kind of shrugged that off. Inflation remains sticky, at about that 3% level. And then there's still question marks in terms of what the Fed's going to do from an interest rate perspective. It does appear that there's going to be another rate cut. I mean, that's kind of the odds, if you will, are that there will be another 25 basis point rate cut. And then going into next year, I think we're going to have a really, significantly reconstituted committee that are making those interest rate decisions. That's likely to be, much more in the camp of future rate cuts. So it certainly has been a good year in the markets. We continue to be, cautiously optimistic for the balance of 2025 and early 2026. But again, it's hard to get much clarity beyond early 2026, and we'll have to wait and see, as some of that data comes out, and hopefully there's more settlement from a geopolitical perspective as well. I'm going to jump ahead. The next several slides really just go through, again, additional market data. I don't want to spend too much time on that, but I do want to get to the Humane System fund lineup. And you can see here on page 20, I always like to take a pause here and just, reiterate that we continue to think that it's a really good, well-structured fund lineup. You have all the critical asset classes covered, from the most conservative money market and stable value to the most aggressive asset classes, small cap value, small cap growth. And then really what I would consider to be the foundation of your retirement plan being that Vanguard Target Date series, which again, I think that for a default investment choice, putting people in a low cost, professionally managed investment that is very well diversified, de-risks automatically, is about as good as it gets, frankly. I think that's kind of 95% of the investment battle right there. So really good choice with the Vanguard series as your default target date series. And then the only other thing I wanted to point out here is that, we talked about the access to private real estate, private equity, private debt, things of that. You actually already have that in your plan with the TIA real estate account. Just a reminder, the TIA real estate account, you basically, it is a private real estate account, direct ownership in real estate. That portfolio for TIA has actually struggled a bit. It's really heavily concentrated on some of the real estate asset classes that haven't been doing particularly well. They're trying to diversify that real estate portfolio, but it's tough. One of the downsides to a private real estate portfolio is their liquidity. They own some of these office buildings and retail spaces, and it's really hard to sell those right now. So that has been a bit of a drag, in terms of relative to other real estate funds. Still positive for the year, but not doing quite as well as we're seeing with some more traditional REIT funds. Any questions on markets before I move ahead? Okay, and I saw my colleague Brent Hartman joined as well. So welcome, Brent.
Thank you.
So as I go through this, again, I'll recap the assets relatively quickly here. You can see total plan assets at about $2.1 billion. The bulk of that in the 403(b) plan, $1.7 billion. And then you can see we break that down across the different plans as well. As this next slide, really breaks down where the assets are concentrated. You can see a lot of money continues to be concentrated in stable value. That really, the bulk of that would be in the TIA traditional account. The TIA traditional account, we continue to believe is an appropriate investment. Probably a lot of that money, frankly, is with retirees, who still have money in the TIA traditional, but TIA traditional, depending on the vintage of your assets or how long you've been in that fund, you could be getting upwards of 6% right now on that. So, a really good choice there. And then there's still quite a bit of money in those frozen legacy contracts at TIA as well. About $500 million sitting in the frozen funds. That's really not a bad thing. And I say that because, from a pricing perspective, TIA is still looking at that as part of the assets that they're managing for University of Maine system. So, even though those frozen assets, they're clearly not active, you're not seeing new contributions going in there, they actually do help from an overall pricing perspective. And then you can see the continued breakdown. I really like to see the continued growth in target date funds, about 18% of plan assets. I'm a huge fan of target date funds in general. And I'm a particularly big fan of the Vanguard Target Date series. So that number at 20%, it's certainly nice to see. And I'm hopeful that that's going to continue to grow. And frankly, confident that it's going to continue to grow since that's your default choice. And anyone who's automatically enrolled in the plan would go into one of those Vanguard Target Date funds. Breaking it down a little bit further, you can see we do have a couple funds that are marked for review based on our scoring methodology. We do not have any change recommendations this quarter, but we do have some funds that are marked for review. The MFS International Value Fund, the JP Morgan Equity Fund, and also the Victory Sycamore Established Value, which is a mid-cap value fund. So you can see, in total, only about 6% of plan assets, but, that's kind of the nature of these reviews, is I'm going to spend quite a bit of time talking about those funds since they are marked for review, but also want to keep it in perspective. The vast majority of the assets in your plan, not just in good standing, but doing really exceptionally well on a year-to-date basis. The next several slides, again, this is where we really break down assets across each one of the plans. Did want to just point out, if you look at just the largest plan as an example, which is the 403B plan, you went from $1.8 billion to $2 billion in assets from the start of the year to the close of the third quarter. That's obviously thanks to strong employee contributions, employer contributions, but frankly, market performance has been a huge part of that as well. It's just been a great year in the market. And again, this is through September 30th. I think if you were to look at that figure as of the close today, it would actually be significantly higher than that as well. So from a scorecard perspective, everything, as I mentioned, we don't have any funds that we're recommending changing at this point, but we do have some funds that have slipped into that marked for review category, and a couple other funds where we've seen that score come down slightly over the past several quarters. A lot of this, frankly, has to do with the market. We've just been in this market that has really favored more of a growth orientation, more of a risk-on orientation as well. So, active managers that tend to look for value, active managers that certainly are focused on value stocks, have underperformed on a relative basis. So, that's definitely one thing that we're a common theme that we're seeing across all of our plans. Something I think is really important to emphasize here is that markets do periodically rotate and markets periodically do go down. I know that, we haven't seen a lot of that over the last few years, but we do believe some of these more conservative value-oriented funds are a very important part of your plan and certainly will be a very important part of your plan if we do see some type of market rotation. Just quickly, you can see the JP Morgan Equity Income Fund. This is your large cap value fund. Scoring a 70, so really right on the verge of that kind of considered for termination category. This is a fund that, as I mentioned earlier, it's a pure value fund. It's managed by a team that really favors financially sound companies. They favor dividend-paying stocks. It's not a fund where you're going to see exposure to those Mag 7 names that we've talked about many, many times in the past. And so the result of that is while the fund is up 13% year to date, so through yesterday, again, the fund's up 13%, but it's still below the 50th percentile, just to put that into perspective. The other thing with this fund, if you look back to the last down year, 2022, this fund was in the top 20th percentile. Then all of a sudden, markets came roaring back in 2023, and this fund was in the 87th percentile. So clearly, it's a fund that is really more defensive in nature, but one that, again, we continue to have great faith in. Similarly, Victory Sycamore Mid-Cap Value Fund, you can see, slipped into that marked for review category as well with a score of 78. Again, this is a fund that really focuses on value. And, that focus, active managers that really focus on value, the more you move up from large cap to mid cap to small cap, the more challenging that becomes, if you're missing out on some of these kind of high risk names that managers like this tend to stay away from. So this is a fund that is scoring a 78. A little bit more concerned with this fund, frankly, in the short term. On a year-to-date basis, this fund is only up about 2%, and it's in the 95th percentile. Similarly, in 2022, it beat 90% of its peer group. But again, in this market, it's really struggled as well. So those are the two funds on this page marked for review. Brent, I didn't know if you had any more kind of insight into either or both of those funds you wanted to share.
Just real quickly, I would point out that JP Morgan Equity Income, it actually has a dividend requirement. A certain percentage of its funds have to pay a dividend, and there's a lot of discipline. If I'm a dividend payer, I'm not going to take on a lot of leverage. And right now, the market is rewarding companies that are a little bit loose and fast with their financial leverage, leveraging up and growing and not necessarily paying dividends. So that conservative nature is holding it back right now. But as Mike pointed out, markets always have cycles, and there will be a time when this shines. And given the last 3 years, what's happened in 23, 24, and year-to-date 25, I would have expected this fund to lag. And Mike's already pointed out, 13%. As an investor, I would never be unhappy with a 13% return, but everything about that fund is explainable, and I agree with Mike's sentiment. The Victory Sycamore is a little bit more sensitive because I understand the environment is challenged, but in and of itself, it's not really performing even as well as I would expect it to perform in that challenged environment. But I would point out, has a very seasoned, established team. Gary Miller's been at the helm of this fund for many, many years, and he's got a couple of portfolio managers, very tenured, very established. They've got a proven process, and over time that process has worked, but there are reasons and understandable reasons why it's underperforming right now.
Yeah, thanks, Brent. It's about 1% of plan assets, so it's a pretty small holding in the plan. Not that matters in terms of we're gonna keep a close eye on it and make appropriate recommendations, but at least it is a relatively small holding. The other fund that really has been just an outstanding performer for a long time in your plan is the Harbor Capital Appreciation, scoring down in the low 80s. That's a fund that we've seen scoring consistently in the high 90s, perfect 100, has had phenomenal years with their concentration in technology stocks. But frankly, has been a little bit off this year. It's still up about 16%. So again, we're in a year where you can be up 16% and still be a little bit off, but that places it in the 60th percentile. The 3-year numbers still look really good, top quartile, but that's one that we're certainly keeping a fairly close eye on as well. There's been some changes at Harbor, which is one of the things. Whenever there's changes, we always keep a really close eye on that, and especially if we start to see underperformance, throws up a little bit of a red flag. Certainly not one, as you can see, still in good standing, so not one that we're prepared to make a change recommendation on, but certainly one that we're keeping a close eye on. MFS International Value, this fund's marked for review, but frankly, I don't think it's going to be marked for review for very long. Absolutely no concerns whatsoever about this fund. I know that it's a foreign large blend fund, so it's a mix of growth and value. But even though the name says, intrinsic value, it actually does have more of a growth lean to it. Unlike U.S. markets, international foreign markets have had more of a value orientation, and so that growth lean, caused some weak performance in 2022, and then also part of the reason that this number has dropped is that they had a really, really strong 2020, and that's rolled off the 5-year averages. So, that kind of dynamic hurt the score. Year to date, MFS International Value, intrinsic value, I should say, is up almost 31%. And it's in the top quartile peer relative. So, we're going to see that score go up. It's actually the best performing fund in the entire portfolio. So, again, it is marked for review, but I would say not a fund that we really have any concerns about at all.
Yeah, I would highlight there that really all the performances in that 5-year period, the 3-year numbers are fantastic, and it's having another fantastic year to date.
Yeah, absolutely. Thanks, Brent. Any questions on any of the actively managed options? Okay, as we get to the target date series, again, I just want to reiterate, really solid choice using the Vanguard target date series. Everything is working well for this series this year in terms of, the fact that they're index-based in a year when indexing is a really good strategy. The overweight tactical positioning to international equities has been very, very beneficial as well. There's still a fairly conservative glide path. So if you look at the Vanguard series, one of the nice things about them is you're getting good performance, but you're not taking on inordinate risk. And when we get to our QDIA review, I'll provide a little bit more details and clarity on that. But overall, it's really, I continue to think, as good a default option as you can have in your plan. The Vanguard 2030 fund, so that would be more heavily fixed income based, someone who's really targeting around 2030 as a retirement. That fund is up over 15% year to date, and it's beating 96% of its peer group. If you go look at a more aggressive fund, the 2060 fund, that fund is up over 20% year to date, and it's beating over 80% of the peer group. So, really across almost all of the vintages, you're seeing not just outstanding absolute performance, but you're seeing outstanding relative performance as well. So, really nice to see that continues to be a bigger and bigger part of your plan as well.
One of the things I like about this fund from a business standpoint is Vanguard has a dominant position in the targeted series. They manage more targeted assets than anybody else, and they continue to win more mandates. So they've got some massive economies of scale that they use to their advantage, keeping their prices very low, keeping that market very competitive, yet they're profitable and able to continue to reinvest back into that business. You can see our target date scoring's a little bit different than our active managed, where we have 70% is quantitative, 30% is qualitative. Here we break that up 50-50. So the qualitative, the guys and gals that run the fund and the underlying vehicles, we pay a lot of attention to. And again, Vanguard's got some business environments that are their scale, their economies, their profitability and reinvestment back into the business allow them to be best in class across those factors under the qualitative factors.
Yeah, and they really, even though they're fairly straightforward funds, fairly simple, and I don't mean that in a bad way.
There's only 5 individual holdings.
Yeah, very, very simple. They also continue to innovate. They're actually coming out with a product that they're rolling out with TIAA that incorporates some guaranteed income. That's something that I'm sure we'll be talking about down the road. In addition to that, I hate to even bring up the phrase collective investment trust legislation, because I feel like we've talked about that now for several years. But, if the collective investment trust regulations change and allow for 403(b) plans to access CITs, we'll be able to immediately reduce the cost of the Vanguard series, as well as several other funds, but particularly the Vanguard series for the UMaine System Plan. I bring that up now because that is going to go before Congress again fairly soon. It continues to get strong bipartisan support. If that does pass, we'll be able to immediately just kind of almost restructure the entire fund lineup and significantly reduce the costs across the board. So we're really keeping our fingers crossed there. Try not to talk about it too much because I feel like it's something that we've been hoping for and wanting for several years now, and they just can't seem to get the legislation across the finish line. You have the TIA traditional as well as the Vanguard money market, both in good standing, and then your full suite of index funds for people who want to just structure, their portfolio using the index funds, all in good standing as well. And then finally, TIA real estate in good standing. Again, I talked about some of the issues with the TIA real estate portfolio. From our perspective, we still think that it's a good investment choice, as well as CREF stock. So your overall plan score remains really strong, with an overall score of 90. That's not a hugely meaningful number. It's just it's not a weighted average, but I really do like this chart because it shows you kind of the scoring trends. The other thing when I look at this fund lineup is that it really has been a very stable fund lineup. We haven't had to make a lot of changes over the years, and certainly that's a good thing as well. So. With that, I want to take a pause before we get to the review of the target date fund, see if there's any questions for either Brent or me on anything we covered so far. No? So, Kelly, do you want me to just kind of roll right into the target date funds?
Yes, I love it.
Okay.
Go for it.
So this is what we call our QDIA review. Again, just a reminder, QDIA is Qualified Default Investment Alternative. Target date funds are your default investment alternative. So basically what that means is that if anyone's auto-enrolled in the plan, doesn't make an investment decision, they automatically go into what's called an age-appropriate target date fund. So if you're auto-enrolled, you're in your 20s, you're likely going to go into a 2065 or even a 2070 fund. If you're auto-enrolled and you're in your 60s, you're probably going to go into a 2025 or 2030 fund. Again, I think that's a really good practice. And I think, utilizing the Vanguard series, they're obviously a really good series from an investment perspective. I also feel like from a risk mitigation perspective, using a good quality index-based target date series, is really helpful as well in terms of mitigating risk. I know that you're a non-ERISA public plan, but I feel like it's only a matter of time before some ambitious attorney decides they're going to target non-ERISA plans and start suing them. We've already seen it, in higher education, in the private higher education. We've seen it in healthcare, seen it in large 401k. So again, I think it makes a lot of sense what you're doing in terms of following ERISA as a best practice. And this is part of that, is making sure that you're periodically reviewing your default investment choice. The first several pages here, I won't spend a lot of time on. It's really just documentation of the process that we follow when we're looking at target date funds. We look at several different aspects of the target date funds. There are a couple different forms of target date funds, what are called to retirement series, meaning they're managed up to one's retirement date, and then through retirement series, ones that are managed through one's retirement date. Vanguard is a through series. The vast majority of funds on the market that are utilized today are in this through series. And the reason for that is that typically when people retire, they actually leave their money in the target date funds. So they'll just take distributions from those as opposed to pulling all the money out. So this is important because the way that the assets are managed is really impacted whether they're to or through. And then the different other types include actively managed series, passively managed series, which is what you're in, or hybrid, which is a mix of active and passive series. So you're in the passive series. One thing I like to point out here with the Vanguard series is that even though the underlying investments are passive, and what I mean by that is all of the asset classes that are covered with Vanguard are indexed or passive. The funds are very much actively managed. I mean, they have people who are making decisions about the asset allocation strategy, the glide path, the tactical weighting of US versus non-US. Those are really important decisions. And those are, decisions that I think Vanguard does a really good job with. The result, as Brent has mentioned earlier, is that, really by far the largest target date series on the market. You can see Vanguard has about 37% of the target date market. The next nearest competitor would be Fidelity at about 14%. So again, just some statistics on target date funds in general, and then specifically the Vanguard series. From an expense perspective, or let me take a step back, from a comparison perspective, what we've done is we've decided to compare the Vanguard series to other index series specifically. And the reason for that is that we don't think it makes sense to go from index or passively managed to actively managed. We suspect that even if you were interested in making a change, that you would want to stick with an index series. So what we've done is we've done a comparison of the Vanguard series to the Nuveen Lifecycle series. So that's the series, the TIA's proprietary target date funds. And then we included the Fidelity Freedom series since they're the next largest on the market. This is really just for comparative purposes because TIA does not allow Fidelity product on their platform, and Fidelity doesn't allow TIA product on their platform. They've just, they're like any other two record keepers in the business where they just don't work well together, I guess, for lack of a better phrase. So the Fidelity Freedom series we put in there really just so you could see, how it compares to another series out there. As we go down from a cost perspective, you can see 8 basis points. You're in the lowest cost version that's available right now for 403B plans. The Nuveen series is 10 basis points. The Fidelity Freedom series is 8 basis points. And then you can see, I think, realistically, if we're looking at it compared to the Nuveen series, you can see the Vanguard series has equity exposure on the long end or further away from retirement at 90% and Nuveen at 95%. So that's kind of what I was talking about, where the Vanguard series tends to have a more conservative asset allocation strategy, and glide path as well, where you can see the Vanguard series has 30% equity exposure 10 years after retirement, where the Nuveen series has 40% equity exposure. Okay. And then this shows you a breakdown of the asset classes that were covered. And really, I think, Brent summarized this in terms of the Vanguard series. You can see you basically have a limited number of asset classes covered, but it works very well. You can see you have intermediate term bond, global bond, and inflation protected bond. And then on the equity side, you basically have large cap, foreign large cap. So really from an asset class perspective, pretty limited, but still very, very effective. This slide shows you the glide path. And so basically what this means is that these numbers over here represent the percentage of assets that are in equities. And then down here at the bottom, this represents the number of years until retirement. So if you have 45 years till retirement, you would be in a 2065 fund, soon to be 2070 fund. And then you can see the Vanguard series has 90% equity exposure. It doesn't show up here because it's kind of right under that blue line. And then that stays at 90% throughout the early years of one's career. And then it starts to de-risk. So as you get closer to retirement, starting 20 years out, you start this de-risking process. And then as you get to retirement, so 0 would represent one's retirement years. And you can see where Vanguard basically flattens out at about 20% equity exposure during the retirement years. So again, not an overly aggressive series. I would say a more conservative series on kind of both the tails, the retirement end of the equation and the further out end of the equation as well. So this is a really important slide. And this is a slide that I hope participants understand because, as you can see here, even as you get closer to retirement, you're still going to have equity exposure in your portfolio. And we think it's really important that participants understand that. These slides really show kind of the risk return of each of the different target date series. And you can see here, the Vanguard series is represented by this kind of reddish triangle, and then the Nuveen series and the Fidelity series with the light blue. Over here, you can see this is return, and then this is volatility. So let's start with the more conservative series. You can see the 2025 vintages. You're getting really slightly better returns with less volatility than Fidelity, and then pretty much right on top of Nuveen. As we move up, you can see very similar returns here with less volatility, again, coming out of the Vanguard series. And then here in the longer dated series, again, you can see Nuveen getting better returns, but with more volatility. And this is directly related to the equity exposure. So again, Vanguard has about 90% equity exposure, Nuveen 95% equity exposure. So you would expect certainly over the last 3 years that Nuveen's performance would be better. The next slide really breaks it down, showing the 5-year performance and volatility as well, and really, tells a very similar story. You can see Vanguard getting outstanding performance, not quite as strong as Nuveen, but doing so with less volatility on the longer dated, and really getting equal performance with less volatility in some of the shorter dated ones as well. So again, I think all the slides, I just want to emphasize what I believe all of these slides do is validate that we continue to think that you're in the right series. And then finally, this shows the Sharpe ratio. So Sharpe ratio is a risk-adjusted measurement of performance, and then beta is a measurement of risk. And you can see, again, the Vanguard series, the 5-year beta, lower, excuse me, my mane coming out. 5-year beta is lower, but the 5-year Sharpe ratio, you can see on a risk-adjusted basis, really kind of right on top of one another as well. Brian, anything I missed as I kind of went through those charts, or anything you want to add there?
Very well done. I just would want to reiterate just how well positioned your participants are in this Vanguard series. I mentioned earlier, there's only 5 individual holdings: U.S. equities, international equities, U.S. bonds, international bonds, and cash. But those 5 individual or portfolios hold well north of 25,000 different individual securities. So these are broadly diversified across U.S. international, large, small, value, growth, and then well diversified in the fixed income arena.
Thanks, Brent. And then just one more chart here. And this really, again, kind of shows you what I was talking about from an up capture perspective. As you would expect, the more aggressive series is going to have more up capture, but not as much down capture. And so that's exactly what we're seeing here. So again, when you think about ERISA as a best practice, our role as fiduciaries is to minimize losses, not maximize gains. So we think Vanguard does a really good job with that. You're definitely getting really good performance, but you're not taking on inordinate risk in doing so. And then I won't read through each one of the performance slides, but you can see I'll pick out a couple. 2025, you can see the 3-year performance of the Vanguard series really beats both Nuveen and Fidelity. The 5-year performance better than Fidelity, slightly trailing Nuveen. This is all done net of expenses, I should say, as well. And then as we jump ahead, I'll go to 2060 as an example. You can see the 3-year performance of Vanguard, 21%, just slightly less than Nuveen, and 12.2, just slightly less than Nuveen as well. But again, that's really directly related to the equity exposure there. To me, what all of this entire presentation does is it just continues to validate that we think the UMaine system is absolutely in the right choice using the Vanguard series. And I do think that, there's going to be hopefully potentially opportunities for improvement down the road, potentially with the expenses if the CIT legislation passes. But also, again, I think, being able to, the Vanguard just announced this partnership with TIAA, where they're going to be incorporating what TIA does really well, which is guaranteed income products, with what Vanguard does really well, which is low cost investment products. And, hopefully that's something that may be beneficial, and we're anxious to see more information about that.
And back to the earlier comments about Fidelity being the second biggest player in here, that really gives Vanguard a leg up in the competition for target date funds, partnering with TIA, who Fidelity is unwilling to do so.
Yeah, absolutely. Any questions on anything that we covered, whether it be target date related or core fund lineup related? Okay, I think the only other agenda item that we had, Kelly, was we have our annual fiduciary training. We sent out that module. It's a pretty straightforward link that members can click on. It goes through about a 20-minute presentation on fiduciary responsibilities. One thing I do want to emphasize when you look at that is that you will hear ERISA referred to a lot. ERISA governs retirement, non-public retirement plans. You folks are not governed by ERISA, but we still follow ERISA as a best practice. We think that that's really important. We think it serves the university and serves the participants really well to do that. So if you go through that and you hear a lot of ERISA, that's the reason why. But we're sending that link out and hopeful that people will take the time to look through that. Like I said, it's about a 20-minute presentation. And I think with that, again, I'll take a pause and see if there's any questions, but I think that's all of the agenda items, Kelly.
Excellent. Thanks so much for that. And Brent, thanks so much for jumping on short notice. And Mike, always appreciate the presentations. And just to speak on the fiduciary training, it's just 20 minutes, and it really helps out a lot to have all our investment committee members take that. It just shows that we've gone above and beyond, and we're just honing the saw, being better fiduciaries. So it's pretty interesting as well. It's not so dry. It's pretty good stuff. So if you do have a chance to do that, I'd appreciate that. So with that being said, I'm going to pass the meeting back to Tracy. She was able to get some extra information, I believe, on tab number 1. But Tracy,
Yeah, thank you, Kelly. Yeah, I reached out to a couple of folks here on some of those questions. One of them was whether or not the UMaine Foundation deposits and invests any UMaine endowments in their portfolios. They don't. So there is no fee for the foundation to charge. It is the monies that reside in the managed investment pool, as I suggested earlier. So that's something that isn't handled internally by our accounting department and runs through our general ledger. The other question that was asked, Trustee McMahon, you asked about charitable remainder trusts. And while we don't have any of those, we do have charitable gift annuities, which are very similar. And what I was referring to, they're giving vehicles, and it is at the end of the beneficiary's life where then that becomes either a gift, an outright gift, or an endowment. And there are no fees on gifts, and there are no fees during the CGA payout phase to those beneficiaries. So according to the document that is agreed to at the time that charitable gift annuity is entered into, that will later determine if there's an endowment and the fee that we would then add, because you asked about the UMaine fee. So it's only then, after the beneficiary passes, that would be applicable.
Thank you.
You're welcome. That's it for me, unless there are any questions.
Any questions? Thanks so much for getting that information, Tracy. I appreciate it.
Sure.
And any other comments on the meeting?
As the only to see online, let me say for the record, I did do the training video.
Excellent. And before Trish Riley jumped off, she did it as well. So thank you for that. I will get to mine this afternoon. I didn't do it before the meeting, so I'd like to wish everybody happy holidays. Hopefully you have rest, relaxation, enjoy family and friends, and looking forward to getting back at it next year in 2026. Thank you.
Thank you. Happy
Have a great
holidays
day.
also.
Bye-bye.